Felix and Winston here, and we've got literally 24 hours till the most important set of data till Wednesday. And Wednesday is the big day. Wednesday is the day when the Fed, the FOMC, decides whether to hold rates, whether to raise rates. And my money is on the hold, as is the market, which is why it's flying so beautifully today. But there are a couple of things you want to watch out for. One is the entire rally has been led by essentially FANG stocks in the US and by the granola stocks in Europe. Look up what the granola stocks are, that's a nice acronym, isn't it? And that gives you an indication that, okay, if you owned the top, probably the largest 15 stocks in in Europe and the US, you would have an amazing year, and hopefully you do. But the rest of the market just hasn't really caught up, right? Even the small cap rallies we're starting to see isn't really anything on the scale of what we're seeing at the top 15 stocks. They're basically driving everything, even the top 7 stocks in the US. And that's slightly concerning because it sort of means the market rally isn't broad. Non-broad rallies typically don't last. If you're wondering, I'm in Monaco, you can probably tell. That's a slight problem. Now, inflation data is expected broadly to come in much lower tomorrow. And if that is the case, the market's going to continue to rally. And we will then not see another rate increase probably for the rest of the year. If the data is a little shifty, so it's a little higher than expected, about 5.2%, and maybe the labor market data continues to be manipulated so severely that it looks like the labor market is still strong, then you might just get the 1 month skip and it might keep going. At least that's the story they're going to try and tell you. I don't really believe it. I think they're done. I think they're done for good. I think there's a lot of indicators out there in the economy, from credit card delinquencies to the real jobs creation data, that actually shows the economy isn't anywhere near as good as we think. The US government issuing $1 trillion worth of debt over the next 6 months, or even 3 months if they do it quickly. It's going to suck massive liquidity out of the market. And if you watched me this morning, you may have seen that the Fed has essentially redefined the importance of the labor market. I think that was the Prince driving past just, I think it was, in its calculations, and essentially saying wage inflation is no longer that important. And the link to real inflation and wage inflation is much smaller than they previously were thinking. And that's sort of new research coming out of the San Francisco Fed. It's a nice article I posted in the community today, if you're into that sort of thing, like former economists here. So I think it all looks pretty good. Like, I just don't really see the huge fly in the ointment, other than that this recovery isn't as broad as we'd like it to be. And that's really the thing I'd watch out for. So the bull market, I think, is going to keep bullish. But if you want it to last, you need margin improvements all around, perhaps except for some of the Dow Jones stocks, which are just going to get hit by retail spending less, and that's kind of okay. Like, I wouldn't worry about that too much if you're in Microsoft or in Nvidia, that kind of thing, because that's where you're going to see the margin expansions, because they can save money, they can lay off people, they can replace people in systems and programmers with AI, and just come up with better products that people are willing to pay for. And I think that's the real story for me in terms of growth. Now, Winston, any final thoughts? It's a little on the hot side, I think. Any final thoughts, Winston?
Oh yes, subscribe guys.
See you on the next one.